Hi guys, welcome to Money by Sunny. Investing is often seen as a complicated and expensive process, and as such, people often fear making mistakes. This is further exacerbated by investment myths, which can be a story, opinion, or belief about investments which are not necessarily true. With so many new investment products and complicated concepts, there are a lot of myths out there. Not to mention other myths that may have been passed down from other generations or based on hearsay. Here are 8 of the most egregious myths you should be aware of when investing. As always, do note that this is not financial advice, as this is merely for educational and entertainment purposes. That said, let's dive right in. Myth number 1. Investing is only for rich people with a lot of money. Thanks to the internet, the barrier to investment is much lower than it used to be. Using investing in the stock market as an example, many online brokers allow you to open accounts with zero minimum deposits. This is in contrast to previous practices where stocks were traditionally purchased through an investment manager. Investment managers can sometimes charge high fees for their services, adding significantly to the cost of a stock. The internet has made investing much cheaper. You aren't limited to penny stocks or companies with low stock prices either, as instead of buying full shares in a company, there is the option of buying fractional shares, which further lowers the barrier to entry. Myth number 2. The stock market is a scam. There are many myths about the stock market, but one of the most popular is that the whole thing is a scam. This is not true. There is an entire industry and financial system and millions of people and transactions that make up the stock market. It happens to be one of the most efficient ways to create wealth in the long term. This myth may have arisen from inexperienced short-term or day traders who are looking to make quick profits from rapid buying and selling of shares, which is something that requires a lot of experience and know-how to properly do. Otherwise, it's very easy to get burned and lose money. From there, it's a natural tendency to think that the market is rigged or conspiring against you, and therefore that the market itself is a scam. If you're investing long-term, however, these short-term movements should not concern you. Myth number 3. Investing is no different from gambling. Sometimes it may seem to be difficult to distinguish between investing and gambling. But there are undoubtedly major differences, and the two practices and accompanying philosophies differ greatly. For one, investors study the market and factors that affect it, and there is an element of research and strategy before any money leaves an investor's pocket. This is as opposed to the hit and hope nature of gambling, where the odds are stacked against the individual gambler. And the aim is pretty much just to get lucky. Another important difference between investing and gambling is the time frame. Investing is a long-term process, whereas gambling is very much more short-term in nature. The goal or purpose of each activity are also divergent. The aim of investing is basically to build wealth over many years, whereas gambling is often about an individual who wants to win a lot of money quickly, such as to hit the jackpot at a casino or strike the lottery. Myth number 4. Always avoid high-risk assets. It's natural for us as human beings to avoid risk, as that is how we are programmed. This is especially true when our money is involved, as there is a very high aversion to losing that money. That being said, high-risk assets are often high-return assets. While there is no such thing as a guaranteed investment, it's sometimes the case that the higher the risk of the asset, the higher the return. Though this is certainly not true every time. The corollary here is that if you want to completely avoid high-risk assets, you could be missing out on a lot of potential gains. Does this mean that your investments should consist only of high-risk assets, so as to maximize your returns? No, definitely not, as that would be taking on a very high level of risk to your money. Investing exclusively in high-risk assets is a bad idea because they often come with high volatility and significant drawdowns. which will distort your expected returns and cause a lot of stress. Instead, like so many things in life, the answer is to strike the right balance between high risk and safer assets so that you're able to take some acceptable level of risk in search of higher returns, while being able to weather the storms when they happen. Myth number 5. Successful investments require a complicated strategy. While successful investments do require some form of strategy, it does not need to be complicated. The more complicated it becomes, the more difficult it can be to make the investment successful, especially if the strategy is not perfect. There are many factors to take into consideration when developing a strategy, but some of the most important factors are the risk tolerance of the investor, the time horizon of the investor, the size of the investment, and the personality of the investor. Instead, there are simpler methods to begin investing. For example, investing in index funds or exchange-traded funds, known as ETFs, is a more straightforward methodology, as it does not require constant monitoring, buying, or selling. Instead, it involves periodically investing in funds with minimal complication. Myth number 6. Investing is not for young people. There's a popular misconception that investing is not for young people. While it is true that investing in assets such as stocks and bonds is more difficult than cash and other low-risk assets due to the volatility and fees, there are many benefits to starting to invest at an early age. While investing may be challenging for people just starting out due to a relative lack of experience or lack of funds, this can be overcome by setting aside small sums every month in the beginning and investing in less volatile and more reliable assets to start with, such as money market or index funds. The main benefit is that it gives the investor an early start, which allows the investments to reap the full benefits of compounding or reinvesting profits. Investing should be seen as a long-term plan to take care of the future in any case, and while the benefits may not be apparent right away, it's always a good idea to get a head start. Myth number 7. Real estate is a bad investment. Investing in real estate certainly carries risk, as the world saw during the subprime crisis more than a decade ago. Also, as opposed to the stock market, it may be difficult for the average person to purchase an investment property unless you have a decent amount of cash to invest. Unless you have a lot of money, it's going to be hard to buy a penthouse in NYC. It's not necessarily all doom and gloom, however. The benefits of investing in real estate can outweigh the risks if carried out properly and with the proper information or research. One advantage of investing in real estate is that it is a tried and tested asset. This means that there will always be a need for a place to live or work in the case of commercial real estate, which creates demand and helps to prop up values. On top of this, there is also the benefit of depreciation due to wear and tear on the property, which can reduce the income tax payable for property owners in some countries. There's also the option of investing in a real estate investment trust rather than in individual properties, which reduces the minimum required investment. This can also help to spread the risk over a portfolio of real estate rather than a single property. It can also open up the door to investing in certain types of real estate, which may be too expensive for individual investors. For example, investing in warehouses or distribution centers to take advantage of the growing e-commerce industry. Before we get to the final myth, be sure to give us a like and subscribe to the channel if you found this useful. Now, on to the final myth. Myth number 8. Any investment is better than no investment. Lastly, a common mistake that many make with their money is to believe that any investment is better than no investment. This idea usually comes from the lack of an understanding of what level of risk is present with any given investment. A person may decide to start investing in stocks because they are looking for a higher return on investment. If this person doesn't understand that they are risking their entire investment on one company, they are making a grave mistake. If the company fails, the investor will lose all of his or her money. This can apply to other asset classes as well. For example, a Squid Game crypto token was recently, in November 2021, uncovered as a scam, causing investors to lose more than $3 million. The answer is to be sure to perform research on investments and sticking to more conventional assets in the beginning. By doing so, a person can find out what level of risk is involved with each investment before deciding whether or not to part with their money. This will allow them to find an investment that is safe and appropriate for them. In conclusion, overall, investing is generally a good thing, but don't believe the myths. There are many misconceptions that might discourage you from investing your money in an intelligent and considered way. And you could be losing out on growing your wealth and beating out inflation as a result. I hope you got some useful insights from this video. Give us a like and subscribe if you did, and see you next time on Money by Sunny.